Today, we're tackling a big one: how to invest $100,000. Whether you've just sold a property, received an inheritance, or saved diligently, making the right investment choices can set you up for long-term success. Before you invest $100,000, it's crucial to first understand your financial goals to ensure your investments align with what you want to achieve. Let's start by asking a few key questions that will help you define these goals clearly. First, identify your purpose for investing this money. Are you looking to use it for retirement in a few decades, saving for a child's education, planning for a major purchase like a house, or aiming to grow your wealth significantly over time? Each of these goals may require a different investment strategy, and clarifying your purpose will guide your decisions. Next, consider your investment timeline. When do you plan to start using this money? If you're investing for the long term, such as more than 10 years, you might be able to take on more risk for potentially higher returns. However, if you have short-term goals, say within the next 3 to 5 years, you'll need a safer and more liquid investment approach to ensure your money is readily available when you need it. Alongside your timeline, assess your risk tolerance. This is essentially about understanding how much market fluctuation you and your finances can handle. Are you comfortable with high-risk, high-reward investments that might involve significant ups and downs? Or do you prefer stability with lower risks, even if it means potentially lower returns? Your comfort with risk can significantly influence your investment choices and how you diversify your portfolio. Another crucial aspect to define is your income needs from this investment. Decide whether you need to generate regular income, perhaps through dividends or interest payments, or whether you are focused solely on accumulating wealth. This distinction will affect whether you choose income-oriented investments like bonds and dividend stocks, or growth-focused assets like stocks and real estate. Also, consider your current financial situation and commitments. Review your existing debts, savings, emergency funds, and any other financial obligations. Ensure that you maintain a healthy cash flow and that your emergency savings are separate from this $100,000 investment. Ideally, your investment strategy should complement your overall financial plan and not stretch your resources too thin. Finally, outline any specific ethical considerations or interests you might have. For example, if sustainability or social responsibility matters to you, consider looking into socially responsible investment options, which allow you to align your investment portfolio with your values without compromising returns. By clearly defining your financial goals and assessing these factors, you set a solid foundation for creating an effective investment plan. This clarity helps you make informed decisions, ensuring your investments serve both your short-term needs and long-term aspirations. Diversification is a fundamental principle in investing that helps manage risk and can enhance your potential for returns. It involves spreading your investments across various asset classes and sectors to reduce the impact of any single investment's poor performance on your overall portfolio. Let's explore how you can effectively diversify your $100,000 investment. To begin, consider allocating your funds across major asset classes like stocks, bonds, and real estate. Each of these asset classes comes with its own risk and return characteristics, and combining them can help balance your portfolio. Stocks usually offer higher potential returns but come with higher risk and volatility. Within stocks, diversification can be achieved by investing across different sectors such as technology, healthcare, and consumer goods. You can further diversify by including both domestic and international stocks, which allows you to benefit from growth in global markets and hedge against local economic fluctuations. Bonds, on the other hand, generally provide more stability and predictable returns. They are typically less volatile than stocks and can act as a buffer during market downturns. To diversify within bonds, consider a mix of government, municipal, and corporate bonds. This mix can balance safety with higher yield potentials. Also, varying bond maturities can help manage interest rate risks. Real estate is another asset class that can provide income and potential appreciation. Instead of buying physical properties, which can be capital intensive, consider real estate investment trusts, REITs. REITs allow you to invest in real estate markets without the responsibilities of property management, providing dividends and the potential for asset appreciation. For those comfortable with more complexity, alternative investments might be considered. This can include commodities like gold or silver, which can serve as a hedge against inflation. Another option is exposure to the emerging asset class of cryptocurrencies, although this comes with high volatility and should be approached cautiously and as a small portion of your overall portfolio. Index funds and exchange-traded funds, ETFs, are excellent tools for achieving diversification. These funds usually track a particular index and provide broad market exposure at a low cost. ETFs especially offer flexible trading similar to stocks and can focus on specific sectors, themes, or geographical areas, allowing easy diversification. Furthermore, consider the role of cash or cash equivalents in your diversification strategy. Maintaining a small cash reserve can provide liquidity and stability, allowing you to take advantage of investment opportunities or cover unexpected expenses without liquidating other assets. Remember, the goal of diversification is not merely to mix investments, but to combine them in a way that minimizes risk while achieving your investment objectives. Regularly review and rebalance your portfolio to ensure that your asset allocation remains aligned with your financial goals, time horizon, and risk tolerance as markets change. By effectively diversifying your portfolio, you can protect your $100,000 investment from market swings and position yourself for steady growth over time. Investing in the stock market is a popular and effective way to grow your wealth over time. With $100,000 to invest, it's important to understand how to strategically allocate your funds in the stock market to achieve your financial goals. Let's dive deeper into the various strategies for investing in stocks. Start by considering individual stocks. Purchasing individual stocks involves buying shares of specific companies that you believe have strong potential for growth. This approach requires thorough research and understanding of each company's financial health, industry position, and growth prospects. It can be rewarding if you pick successful companies, but it also involves higher risk if those companies underperform. To manage this risk, consider diversifying across different industries and sectors. For those seeking a more hands-off approach, mutual funds and exchange-traded funds, ETFs, are excellent options. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. They are managed by professional fund managers and offer diversification across various assets, which can mitigate risk. ETFs, similar to mutual funds, track indexes or sectors and can be traded on the stock exchange like individual stocks. They offer diversification, low expense ratios, and the flexibility of stock trading. Another key strategy is investing in dividend stocks. Dividend stocks are shares in companies that pay out a portion of their earnings to shareholders regularly, usually quarterly. These can provide a steady income stream in addition to potential stock price appreciation. Companies that offer dividends are often well established, suggesting stability and a strong track record. Reinvesting dividends can also compound your returns over time. Consider also the value versus growth investing strategies. Value investing involves selecting stocks that appear to be undervalued by the market. These stocks often belong to mature companies with stable profits but slower growth. Growth investing, on the other hand, focuses on companies that are expected to grow at an above-average rate compared to their industry. Growth stocks can offer substantial returns, but with added volatility and risk. Sector-specific investments allow you to focus on particular industries like technology, healthcare, or renewable energy, which you believe will outperform in the future. This strategy requires keeping abreast of industry trends and economic factors that might impact these sectors. For a broader approach, consider investing internationally. Diversifying globally exposes your portfolio to opportunities in emerging markets and international companies that may not be available through the U.S. markets. International stocks can also provide currency diversification and geopolitical risk mitigation. Finally, consider your investment timeline and risk tolerance when selecting stock investments. Stocks outperform other asset classes over long periods, but they can be volatile in the short term. If you're investing for the long run, more exposure to stocks could be appropriate. Otherwise, blend your stock investments with other, more stable asset classes to cushion against volatility. The stock market offers numerous opportunities to grow your wealth, but it's vital to maintain a diversified portfolio that aligns with your financial goals and risk appetite. Regularly review and adjust your investments as needed to stay on track with your objectives. Fixed income investments are an integral part of a diversified portfolio, particularly for those seeking stability and predictable returns. For investors with $100,000, these assets can provide consistent income and help balance the volatility of stock market investments. Let's explore how you can incorporate fixed income investments into your strategy. Start with government bonds. These are debt securities issued by a government and are considered one of the safest investments available. U.S. Treasury bonds, for example, are backed by the full faith and credit of the U.S. government, making them very low risk. They provide regular interest payments and return the principal at maturity. You can choose from various maturities, including short-term Treasury bills, medium-term notes, and long-term bonds, depending on your investment horizon and income needs. Next, consider corporate bonds. These bonds are issued by companies seeking to raise capital. They typically offer higher yields than government bonds, reflecting the higher risk of investing in private enterprises. When selecting corporate bonds, it's important to assess the credit rating of the issuing company to gauge the risk of default. Investment-grade bonds rated BBB or higher offer more stability, while high-yield or junk bonds rated BB and below can provide higher returns but come with increased risk. Municipal bonds are another option, particularly attractive for investors in higher tax brackets, as they often provide tax-free interest at the federal level and sometimes at state and local levels as well. These bonds are issued by states, cities, and other local government entities to fund public projects. While slightly riskier than federal government bonds, municipal bonds can still be a relatively safe investment with the added benefit of tax advantages. Consider also the benefits of bond mutual funds and exchange-traded funds, ETFs. These funds pool money from many investors to purchase a diversified portfolio of bonds. Bond funds can offer diversification across different types of bonds and maturities, reducing risk and providing a steady stream of income. They are particularly useful for investors who may not have the expertise or time to manage individual bond investments. Certificates of deposit, CDs, offer another fixed income option. CDs are time deposits offered by banks that typically pay a fixed interest rate over a specified term, ranging from a few months to several years. They are insured by the FDIC up to certain limits, making them a very safe investment. The trade-off for this safety is lower returns compared to other fixed income options, but they can be a good choice for conservative investors seeking security. Lastly, consider annuities as a fixed income investment. Annuities are contracts with an insurance company that provides a stream of payments over time in exchange for an initial lump sum investment. They can be structured to provide income for a set period or the remainder of your life. While they offer stability and can be tailored to meet specific income needs, they are complex products with fees and restrictions that require careful consideration. Integrating fixed income investments into your portfolio can provide a balance of risk and reward, helping to protect your capital and providing predictable income streams. As always, tailor your fixed income investments to complement your overall financial strategy and risk tolerance. And review your portfolio regularly to ensure it continues to meet your needs. Investing in real estate can be an excellent way to diversify your portfolio and generate income. With $100,000 to invest, there are several avenues you can explore within the real estate sector. Let's take a closer look at the various ways you can invest in real estate and maximize your returns. First, consider purchasing rental properties. This traditional approach involves buying residential or commercial real estate to rent out to tenants. Rental properties can generate a steady stream of income through monthly rent payments, which can provide cash flow and help cover your mortgage and other expenses. When buying rental properties, it's important to research the local market effectively. Analyze factors such as property prices, rental rates, vacancy rates, and the economic outlook of the area to ensure you're making a sound investment. Consider properties in desirable neighborhoods or areas with strong job growth, as these attributes can lead to higher rental demand and property appreciation. If managing a physical property sounds daunting, you might explore real estate investment trusts, or REITs. REITs are companies that own, operate, or finance income-producing real estate across a variety of sectors. By investing in publicly traded REITs, you can enjoy liquidity similar to stocks, as they are bought and sold on major exchanges. REITs are designed to provide a steady income stream, as they are required to distribute at least 90% of their taxable income to shareholders as dividends. This investment option allows you to gain exposure to real estate without the need for direct property management or the significant capital required to purchase physical properties. Another option is to invest in real estate crowdfunding platforms. These platforms allow you to pool your money with other investors to finance real estate projects. With some platforms allowing investment with as little as $1,000, crowdfunding can provide an accessible way to invest in commercial properties, apartment complexes, and more, enabling you to diversify into larger projects that might otherwise require substantial capital. Carefully evaluate the platforms and projects you choose to ensure their credibility and potential returns. Consider also the potential of flipping properties. This strategy involves purchasing undervalued properties, renovating them, and selling them for a profit. It requires a good understanding of the real estate market, renovation costs, and the ability to manage construction projects efficiently. If you have the skills and resources to undertake renovations, flipping can yield significant profits, but it also comes with risks and potential pitfalls if the market fluctuates or renovations exceed budget. Another innovative approach is to buy into vacation rental properties. This investment strategy leverages platforms like Airbnb or VRBO, where you can rent out homes or apartments on a short-term basis to travelers. Locations in tourist hotspots can often yield high rental income, but it's crucial to be aware of local regulations and zoning laws regarding short-term rentals. Managing a vacation rental can also require more involvement, as it involves turnover management, maintenance, and customer service. Do not overlook the potential benefits of investing in raw land. While this can be a longer-term investment strategy, purchasing land in a fast-growing area can yield substantial appreciation over time. You can eventually develop the land or hold it until property values increase. Do thorough research on zoning laws, future developments, and market trends in the area to ensure your land investment aligns with future growth potential. For those interested in less active forms of real estate investment, consider investing in real estate mutual funds. These funds pool money from various investors to buy a diversified portfolio of real estate assets. They offer professional management and can provide exposure to different types of real estate without needing direct ownership. Investing in retirement accounts is a crucial strategy for building a secure financial future. With $100,000 at your disposal, it's essential to consider tax-advantaged accounts that can significantly enhance your long-term wealth. Let's explore the various types of retirement accounts and how to effectively use them for your investment strategy. First, consider maxing out contributions to a 401k plan if your employer offers one. A 401k allows you to invest a portion of your pre-tax income, reducing your taxable income for the year. Many employers also offer matching contributions, meaning they will match a percentage of what you contribute, effectively giving you free money. This match can significantly boost your retirement savings over time. Aim to contribute at least enough to receive the full employer match, as it's essentially an immediate return on your investment. Next, explore individual retirement accounts or IRAs. Traditional IRAs allow you to contribute pre-tax dollars, which lowers your taxable income, and your investments grow tax-deferred until you withdraw them in retirement. These funds provide a safety net when life throws unexpected challenges your way, ensuring your long-term investments remain intact and giving you the confidence to make strategic financial decisions. By laying this foundation of financial stability, you're better positioned to take calculated risks with your $100,000 investment and pursue your long-term financial goals effectively. If you found this video helpful, please like and subscribe to Channel Name. Drop a comment below sharing how you would invest $100,000, or if there are topics you'd like us to cover next. Here's to smart investing and financial growth.